Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields down again as we head into a holiday weekend. Yes, we pushed through that pivotal 275 yield that we've been talking about. Remember when the market was kind of stuck between 280 and 290? We were anticipating, and a lot of analysts were anticipating, the 10-year yields would go to 3%. Others, a few, I think the minority, were suggesting if possibly we could see yields decline back to 275. Either one level we got to was going to see a big macro shift. And while we did get to 275, we did push through it a little bit. We did not see that macro shift. Yes, a lot of shorts are getting squeezed out here. Let's not forget a lot of the leverage funds out there, the hedge funds, are net short 10 years with the idea, obviously, that either one, that rates are going higher, and two, that the yield curve may re-steepen. But while the rates are going higher, the yield curve is definitely not re-steepened. And I think right now there's this uncertainty fear trade that the bond market is reading. When we look at the volatility rises and the price swings in equities, when we look at the uncertainty out of Washington, and certainly what's going on in Europe and in Asia from a central bank's perspective, how they're going to be going through changes, the bond market's a little bit weary, and likewise domestic growth and inflation numbers that the Fed has been banking on to raise rates may be under some question. Now, I think if you look at market volatility in the treasury space, it is elevated, as it should be. We're seeing it elevated in equities as well, in other areas, in currencies. So right now, bond volatility or market volatility across the macro picture is higher across the board, as it should be. Now, bond volatility is lagging, I think, into where relative moves that we've seen in other buckets. However, it is up, and up means uncertainty is on the rise. And as we are on this precariously sitting at 275 yield, I think if we stay here heading after the weekend and into employment next week, that there could be a major shift. A lot of these shorts are holding out that this is going to be a good resistance level, and they're going to maybe wait and see if we see a normalization trade back into that 280, 290 range, with the Fed able to then nudge us closer to 3%. But I think that's a hope trade, and as one of my mentors told me a long time, hope is a bad hedge. So now we're looking ahead to next week. We've got employment, we've got a lot of huge amounts of data coming through the pipe. And then on April 6th, on Friday, Chairman Powell has scheduled a testimony here in Chicago. So he'll be speaking about the economy. It'll be interesting to see his thoughts on not only on fourth quarter GDP, which came in higher than expected, but the GDP Now numbers that came out today were also higher than last. So we were looking at 1.8 about a week ago. GDP Now seeing closer to 2.4. That's very positive, but still not where we want it to be. 3% was kind of the line in the sand for the president and his administration and what he wants and what he wants to accomplish. And given the tax cuts that have been put into place, given the equity market's ability to recover some of those losses, it seems suspect as to why the bond market is so stubborn in seeing yields rise. So right now, I think Mr. Powell will be speaking out of Chicago. Will look to explain some of those things. Likewise, the flatness of the yield curve remains an enigma, and I think he's going to have to talk about that as well. So as we head into a holiday, the bond market is rallying, yields on their lows. This is Todd Colvin coming to you from the floor of the CME Group.